Good morning, everyone. For those of you who are wondering about the theme music, I'll show you my answer to that question, and it is right here. That, for those of you who are of a certain age, will recognize that as a 1965 Mustang. I can't see y'all, so forgive me if I'm staring into space here. That's a 1965 Mustang. That was my high school graduation present, which also dates me. But it also says something about the presentation that I'm going to give, which is that it's going to be a little bit vertigo-inducing, the things that we're going to talk about. So this is my way of saying that I appreciate that when we're talking about the future of transportation and cars, I have that nostalgia for a different era. So when you get nervous about the things that we're talking about, I want you to know that I share that feeling of discomfort that talking about the future sometimes brings. And I'd like to say straight away that it's an honor to be back here. I'm surprised so many people are here. I was hoping secretly, I think, that there would be, most of you all would have wanted to go home by now and there'd be one table of people and we could just sit around the table and talk about these things. And the reason that I feel that is because the things that I want to talk about today are not things that I'm entirely sure of. It's the economic development effects of a disrupted technology environment that we're all going to be living in. So as we go through this presentation, I want you to feel free to interrupt me at any time. I know that we have a Bonfire app, but I don't mind being interrupted on the spot. And if we were going to do a chart at the end of this of what do you feel about what John had to say, I can do that chart for you now. A third of you would say he doesn't know what he's talking about. The other thirds would say, I know what he's talking about and he's wrong. And the last third would say something like, nah, I don't really care. So I'm going to save us the embarrassment of doing that, and I'm just going to talk a little bit about the economy generally, because I think when we talk about the economy, it helps us understand where we're going in terms of these economic development trends that I want to talk about. So when I had our analysts at the office just take a quick look at the state of Missouri, and it's a little bit unfair, but you know, I do this from a site selector perspective. What do the high level looks at the state come across as? And so private sector employment growth, you see that you track the national average fairly closely. You didn't come out of the recession quite as aggressively, but again, tracking the national economy. This is the so-so. This is your average annual unemployment, also tracking the nation. And I don't want to take any of the enthusiasm of your elected officials away when they tell you how low your unemployment rate is, because it's very, very low nationally. And so you reflect that same trend. And the same with labor force participation, which for those data geeks out there, you will know is a little bit different. But the GDP at the state also roughly tracks the nation. So this is the so-so. But there's some very good things that we see trending in Missouri. The median household income has taken a jump lately. That's a very encouraging sign at the state level. And this little blip right here, this rate of new business formation, really attracts my attention in a positive way, because as a surrogate for entrepreneurial activity, new business formations, and listening to the video on Joplin, and I saw that, I think it was on CBS on the day of the anniversary. They did a terrific job on talking about the Joplin recovery as well. So new business formations is an excellent indicator. And then your poverty rate, individual poverty rate, has gone down. I see that as positive. But there were two things that kind of jumped out at me that were matters of concern. And one of those was, probably the most important one, was the patents per 1,000 population. So if I want another proxy on kind of the tech savviness of a state, I look at the patents. Now, it's really not a very good indicator, because a lot of patents are issued by large corporations and the relative position of large corporations, but you see it going up at the national level, and you see your growth being more or less flat. So I think bear in mind that these kind of proxies and then per capita disposable income running well below the national average. And that's a little misleading because that doesn't necessarily reflect your buying power. But these are the kind of things that say, well, let's make sure that we track these on a broader level. And that broader level is on the national economy. And I'm going to go over these fairly quickly but I wanted to show you something that I showed 2 years ago. We've updated it. And this is something that we produced that was picked up nationally. And I'll cue up the slide in a moment, but let me introduce it first by saying that we've tracked every major metropolitan area in the country over time, up until July of last year, by population growth and decline. So if we can cue up our website, and we'll put this in motion, and you can focus on Kansas City. You can go to our website and look at this as well, and we'll discuss it when it's over, because I think it's really important. So basically, over a time period, you will see in each metro area the number of jobs gained and lost, dating back over a decade now. So we'll set this in motion momentarily, I hope. So those of you who haven't seen it before, we're following a timeline. Are you all with me? We're following a timeline here, and you can scroll down to Kansas City, actually. If you put the pointer over Kansas City, there's Topeka, Lawrence. This is every metropolitan area in the year. There's Kansas City. So here we are in 2002, and red, you can pause that for just a second. There you go. So basically, the size of the bubble is the number of jobs gained or lost, and red is loss and blue is gain. And the size of the bubbles are up there. The tiny little bubble, I'm sorry, this looks like an eye test. I'm going to walk over here and remind myself. I think the tiny little bubble is 10,000 jobs gained or lost, and this is year over year. So what does that say? July 2003, Kansas City gained 5,300 jobs. And let's set it back in motion. And now we're in 2003, and that burst of red bubbles there was the tech bust that hit the nation pretty hard. And now we're moving into 2005. And stop it there for a second. You all know what that is, right? That's Katrina. So the Katrina hits the New Orleans area very hard. The only other red bubbles in 2006, by the way, are up there in the automotive industry. That's the greater Detroit and Flint area. So they were the only ones that were hemorrhaging jobs in 2006, other than the Katrina effect, which ends fairly quickly. So let's set it back in motion. And we're going into 2007 here. And I'll just let it run here. And I think you all know what are coming. We'll stop it again if you don't mind. So in February of 2008, roughly, let's just say this winter of 07, 08, there were some early indicators, and it always makes me a little bit anxious to recall that time, but there were plenty of indicators that something was seriously wrong. And those early indicators came in Florida and California. Ignore the upper Midwest. That was still the loss of automotive jobs. But what was starting to happen in California and Florida was the first signs of that recession and the dependence on the housing industry and construction jobs. So set it in motion, you'll see how this begins to spread. And those of you all of us who've lived through this will appreciate what this was doing to the national. Let's stop it again in roughly April. So in the spring of 2010, we were really suffering. But the economists were telling us that we were coming out of the recession. The reason they were is because the job loss had stopped. We weren't losing more jobs. But when we set it in motion, and I'll let it run now, you'll see that we start regaining all of these jobs that we lost, but not at the same level at which we lost them. So we're moving into 2012, and with few exceptions, most of the country has rebounded. But there are two lessons, as I'll just let it run out, and please feel free to go to our website and scroll over your community. If you're a metro area, you'll find yourself. But there are two really important lessons that I want to communicate to you about this. That this really represented a reset of the economy. By that I mean that the jobs that were lost were not ones that we regained. That's point number one. And point number two is that the larger reset of the economy that this represented was a crisis that was long time coming and from which we will not recover, because the whole notion of what our workforce is and how we interact with that workforce is undergoing a radical change. And that's really the topic of my conversation. Thank you, by the way, for queuing that up. That was great. So I am going to do a couple of charts to illustrate, and then we'll get into my talk proper. So this is an indication of how severe that recession was. We tracked all the recessions going back to the early 70s, and you can see that the current one was both, recent one, was both longer and deeper than any other that we'd experienced. But here's where it starts coming home, and here's where the effects of it are starting to be felt. This is the educational attainment of the labor force. So about a little more than a third of the population has a college degree. Almost 2/3 does not. But look at the skills gap in the share of the population 25 or older. If you have a college degree, your unemployment rate is only about 2.6, and just about double that without a 4-year degree. So whatever else we're doing in economic development, this is determinative. An uneducated workforce will be an unemployable workforce. And that itself is a shift from the earlier part of the last decade. And even to bring that point home even more forcefully, look at job growth by wage category. And the yellow there is the middle wage job, and the red is the high wage job, and then the low wage job. And look who's lagging. So when you hear people talk about the decline of middle class jobs, middle wage jobs, this is evidence of it, and this is out through 2015, indexed from 1 in early 2000. Now, compounding that problem, do I sound academic? Do I sound really like you're in a college lecture? Those of you who, some of my happiest moments in school were in my sleep-deprived state, was falling asleep during lectures, and I think that was some of the best sleep I ever got. So I hope that doesn't have this effect on you. But in terms of those middle wage jobs, look at the one that economic developers have been most focused on all this time, and that is employment in manufacturing, which since 1970 has fallen by 7 million. 7 million. And when you look at that employment by industry sector, and I know there's a lot of lines up there to follow, but the red one is manufacturing, and you see that almost everybody else is up in terms of employment, except for manufacturing. In fact, over the last 30 years, we've dropped from a quarter of our jobs nationally to just 9% are in manufacturing. Now, I had some great exchanges in preparation for this with y'all at the Missouri Department of Economic Development, and they said, you can go ahead and be political. But I thought to myself, if I'm political, I will offend everyone. Because the first thing I want to say is that neither party is being honest with you about the manufacturing reality. Neither is. Neither candidate or neither party. Because the return of manufacturing jobs is not a function of the outsourcing or any of those other things. It's really about technology. And we will not regain employment in the manufacturing sector, and this is where Mike comes up and yanks me off by the collar. But maybe he doesn't. Because I think slowly we're coming to that reality, that understanding that our economy is not going to grow on the basis of manufacturing jobs. And that's a hard pill to swallow, a very hard pill. And it's hard across the board to understand that. And I want to just emphasize that to you, that this is not a critique of manufacturing, and it's not a way of saying to you that manufacturing doesn't matter. I'll say to you, and I want this, because I always get in trouble over this point, I think manufacturing is more important than ever. But there's a difference between the importance of manufacturing to our national economy and the economy in Missouri. There's a difference between that and manufacturing employment. Are you all with me on that? And let me make another statement that I made 2 years ago, and it caused a little bit of a ripple, and it will again. Business is not in the business of creating jobs. That's not why business exists. That's not why anyone who's a business person, every business person in the room is going to understand that, and every economic developer is going to get weak in the knees. So I want to remind us that when we're doing the things that we do in economic development, that employment growth is a byproduct. It is not the goal of business. So when we look at the industry share of employment, and these are readily available data, look at manufacturing as a share of employment, while everyone else has stayed relatively steady or gone up a little bit, only manufacturing has seen a massive decline. So why is that? What's the bigger context for this? And now we're going to get into the heart of the presentation, and this is where I really don't know exactly what I'm talking about. And I'll need your help, because understanding these trends is hugely important. And when I last gave this presentation, I did kind of a broad overview of radically changing technology trends. And I asked the room, and I can ask again, how many of you would be 100% comfortable with having a chip implanted in your body? Do you remember that question? And is anyone willing to raise their hand on that? Maybe 2 or 3 people. How many of y'all have pets? Yeah, most of you. And how many of your pets have chips? Virtually all of them. So that was just one small example of the way in which we're still queasy about disruption. But we're not queasy anymore when we go out there and no one's looking for a phone booth in downtown Kansas City anymore. Is there even a phone booth exist anymore? I don't think so. So when we think about disruption, we really need to think about the ways in which what we take for granted are changing. And I invite you individually. If we were, it was a great tour yesterday that the folks for Kansas City put on, and among the places that we visited was one of Sprint's little design centers. What was that called?
Sprint Accelerator.
Thank you, Sprint Accelerator. And one of the comments that was made I thought was really interesting, that when their new CEO said, to his senior vice presidents, you all need to think more entrepreneurially, and they came back and they said, okay, what does that mean? How do we think entrepreneurially? Well, for a starter, it means that you begin to question things that you might have taken for granted. And I do that every day. I do that reflexively. So when I go to my car and I open my car with my remote fob, and then I come home at night and I didn't leave the porch light on and I'm fumbling with a key, I'm saying to myself, why am I doing this? Why don't I have a remote to open my front door? Or better yet, why doesn't it just recognize me as the way that my cars are doing now and open the door for me? What's going on there? That's what it means to think entrepreneurially, to question every single aspect of the way that we interact with our environment. And maybe the most radical of those is going to be in the convergence of 3 disruptive trends. And I'm going to use, instead of talking about all the ways in which our world is being disrupted with implanted chips and with entirely new communications technologies and all that, I'm just going to focus on one thing, and that's autonomous vehicles. And so that's what we're going to be talking about. So at the heart of the autonomous vehicles are the convergence of 3 different disruptive trends. And this comes pretty much from this week's Economist, and also from my discussions with my friend Chris Tomlinson at Houston Chronicle and some of the people at The Economist itself. The convergence of these 3 disruptive trends are asset-light business models, and we'll talk about what that means, the sharing economy, and a non-ownership model. So that's what we're going to be talking about. We're going to be talking about it in the context of this funny little thing, which is the autonomous vehicle. So let's start by talking about Uber. Now, how many of you know that Uber is now the highest valued startup in history? Do you all know that? What you may not know is that Uber's valuation at roughly $70 billion is a third higher than all of GM. Seriously. Now, tell me what sense that makes. Tell me what sense that makes. I think GM's profits, I don't have my notes in front of me, I think GM's profits were, $150 billion last year? And Uber lost about $1 billion. So tell me, how can this be? Sorry?
Look at Amazon.
Say that again?
Look at Amazon.
Look at Amazon. Amazon had losses for over a decade, didn't they? That's the right answer, by the way. It's part of the answer. And so if we go back here and we look at this convergence of trends, it's the lack of assets that Wall Street is rewarding, not the presence of assets. Because assets depreciate, they change, and they don't participate in the sharing economy. So whether we as economic developers want to buy this story or not, Wall Street has already bought it. And they bought it very handsomely. So asset light, we talked in our tour yesterday, we went to, who was Herb with? Think Big. So I asked Herb, who was very familiar with WeWork, what he thought about it and what it meant for his model. And I realized that y'all probably don't know about WeWork. WeWork is another startup. It's about 6 years old now. And it's also asset light. WeWork is valued, it was valued 3 years ago, I don't know what they are now, at about $5 billion. And all they do is flip real estate space in the Think Big model. They go out and they'll release. They don't own any real estate, but they set it up for techies. And so what's the big deal? Why is someone who's in a real estate game valued that highly? Again, asset light and plugs directly into the sharing economy. So while we're going to talk about autonomous vehicles as a case study, the bigger context for this is that the sharing economy is really radically redefining where value exists. And by the way, if you're not understanding me, that's okay, I'm not understanding me. But I'm watching it. And I'm suggesting to you that we as economic developers need to watch this very closely. And the non-ownership model would be the most interesting aspect of that, and we'll get there in a second. So, this is from The Guardian recently. This is Pittsburgh, which this week, next week, y'all read the papers on this, will be using driverless Ubers in Pittsburgh. So we're not talking about 2020, 2017. We're talking about this week. You will be able to call up an Uber vehicle that will ferry you around Pittsburgh. I want to make sure that in this discussion we keep coming back to economic development, because that's what I don't want to wow you with technology. Most of you are ahead of me on that anyway. I don't want to try to be a futurist. I'm not. I don't know what the future is going to hold. I'm concerned with the present and with the way that economic development responds to this present. So you can't read this. This is kind of an eye chart. But this, and I think you have, anyone who wants the presentation, just check with Mike's team and they'll be happy to share it with you. But this just gives you a timeline from Google's first discussions of the self-driving car. Actually began quite a bit before that, up until Ford announcing, by the way, you can't read that bottom line there, announcing that it will have a fleet of self-driving cars, no steering wheel, in 2021. And so I want to talk about how we understand this question of disruption in our economic development world across three axes: employment, supply chain, and social norms. So I'm going to take a quick breather and just get a drink of water and ask you, so far, are there any questions about what we've said so far? Because as we look at these, it'll be, I think, apparent that we're not going to go back. I actually had a car, that 1965 Mustang was my high school graduation present. My car before then was a Triumph TR3. Do any of y'all know what the TR3 looks like? It was a 1963 TR3. In the office the other day, I have little models of all the cars I've owned. It's one of my little quirks. And I had a little picture of a little replica of a TR3. And one of my team members, quite a bit younger than me, walked up and says, "That's really cool." And I said, "Yeah, it was my first car." And he says, as he was saying it, he was kind of embarrassed. He says, "It looks like an antique." And I thought to myself, well, it's actually more true than you think, because in the trunk, in the boot of my TR3 was a L-shaped device. Does anybody know what that was? It was a crank. On a cold morning, I could get out and crank the car to a start by pulling the choke out halfway. So my point in telling this story is not to talk about age, but to talk about how astonishingly quick change occurs. From a previous generation, there were no cars, to my actually having the option of hand cranking it to someone who walks up to the car, the door opens for them, and they step in, and in the very near future, the car takes them somewhere. All in the space of 2 generations. So it's really quite extraordinary that when we think about this speed of disruption, and so I had the opportunity, when I do these kind of talks, I try to get to people who are into the industry. And so I got to some senior people at Ford, and I asked them about kind of their bigger plans, and they made a very interesting point that I'll mention a couple of times, which is that this investment that's taking place for self-driving fleets of Ford cars is a non-negotiable issue with them. They absolutely are investing wholly in that. And so the dates that they're giving are of concern to them only because they may not get to the market with fleets of cars ahead of the competition, which is coming from all directions. From all directions. So let's take a look at these 3 disruptive trends along the lines of employment, supply chain, and social norms with an eye toward how we as economic developers, I'd like to think that when we have this discussion about disruptive trends, it's not just something that you squirrel away and maybe talk about once a year, but that you begin to see that it affects the way you do business when you go to work on Monday morning. That's how critical I think it is that we have this discussion. So let's start with a view of those 3 different elements of disruption and ask about employment. How will this disruptive technology that is the self-driving vehicle affect employment? And the way to ask that question is, what is the fundamental economic fact about automobiles? Anybody want to venture an answer to that question? What is the fundamental economic fact about automobiles? I thought about this a long time. Here's the answer I came up with. This is the fundamental fact about, economic fact about automobiles, is that you individually own them. You have responsibility for them, you have liability for them, you own them. When that model breaks, everything changes. So the 2 big things to think about with autonomous vehicles are not just that they're driving themselves, we'll talk about that under the question of changing culture, but that you will not necessarily need to own them. So here's a chart that you'll have trouble reading, but I really want you to go back and view this. This is a little bit shocking. NPR has this on their website in a timeline. I don't want to show the timeline here, but I will tell you. I'll walk up here so that you can see. That light blue, you all see that aqua? Where you see the aqua, that is the most common job in the state of Missouri and virtually every state in the union. The most common job is a truck driver. Did you all know that? I didn't. I didn't know it. So there's a few exceptions. You'll see primary school teachers in Florida and Alaska, software developers in Utah, Colorado, Washington State. But essentially, your most common job in Missouri and in virtually every state in the union is truck drivers. So why does this matter? Because we're talking about autonomous vehicles. And for those of you who are wondering when this is going to happen, it's happening now. It's happening now. It's happening in Europe, it's happening in Nevada, it's happening in a number of different places where fleets of driverless trucks are starting to hit the road. So we're not waiting to 2021 for this. This is happening now. And bear in mind, as economic developers, where your jobs are here. So let's take a look at what that means across the board. So this is 2016 employment and number of jobs in the country. So 3.3 million truck and delivery drivers nationally. So that's everyone. That's everyone from licensed long haul to the UPS person that delivers your package to the pizza driver. Are you hearing me right? Yes. Every single one of those jobs could go away within a decade. Every single one. Now this is where the ripple effects begin. I can't quite read that, I have to get a little closer. 1.8 million, what does that say? Car dealerships. Car dealerships. Automotive parts. All of those, at a minimum, vulnerable. At a minimum. So I'm going to say something that's going to be even a little bit more shocking. I said that we did a big project for the state of Delaware and for a group called the Business Roundtable, and on that board of that group was a owner of Ford dealerships, and this is a couple of years ago, and he said, "Are you telling me I'm going to be out of business?" And he was a little bit belligerent about it, and I said, "No, of course not. I love my cars." But yes, he's vulnerable. And so when I talked to Ford, one of the things that they said was, we're in the business of producing cars, traditionally, but we've never had margins there. Those margins have never been there for us. And in effect, if we can lease these driverless vehicles, we're good. We're good. And in effect, what he was saying was, we're ready to jettison our entire dealer network. It won't necessarily be important to us anymore. Now think about you, chambers of commerce, think about your employment structure, think about that. So here's another one. 900 and pushing close to 1 million people. Sorry, I have to get close to read this. Taxi drivers, chauffeurs, and bus drivers. So those of you who rent cars at the airport, you're going to take that car back to the rental car place, and then you're going to get on a bus, right? And the Hertz bus is going to take you to the terminal. Why is there a driver in that bus? All potentially gone. Including those Uber drivers, by the way. And so why, again, back to the question of why Wall Street is rewarding Uber so highly, is that they don't have a workforce. Every one of those Uber drivers is contracted. So it goes on. It goes on. So we've got 500,000 or so direct property and casualty insurance carriers. Why? Why is that up there? I know the answer. Because we're not going to have accidents anymore. We're not going to have accidents anymore. I know that there are those of you, and I've talked to some of you, and I'm among them, who are still queasy about self-driving cars. But however queasy you are about the software going bad on the car, it's nothing compared to the drunk teenager that's occupying those roads with you every Friday night. We virtually will eliminate accidents as a result of this. So all of that industry, that 500,000 industry employment, probably gone. And then last, up there, is automotive equipment rental and leasing. Now that's a little bit screwy because one of the questions that you will have is, what will the loss of those jobs mean? What is the future of those jobs? And we'll get to that. But the disruptions that we're talking about include the supply chain. And the supply chain is both feeding into the production of these vehicles and at the back end that supports them. So I want you to think about, in an automotive-dependent state in many ways, like Missouri, what the effects on that supply chain will be, forward and backward, both in terms of the self-driving vehicle and in terms of the potential for no longer owning those vehicles. Among those things, and excuse me while I refer to my notes, is also the convenience factor. If you think about the support structure for trucking alone, all of those truck stops, all of the motels, all of the quick stops, filling stations, all of that have employment connected with them that we weren't showing up there, every one of which jobs is also vulnerable. And the infrastructure that we use to support this can undergo a radical change. All of your highway planning undergoes a major change. And then there's the social norms, where the new becomes normal and the old becomes quaint. And the phone booth is an example of that. And for those of you who see this conversation about the self-driving car as somehow really out at the outer limits, bear in mind that you are increasingly, any of you who have a 2015 or later car know that this technology is already happening. And it happens in all the ways in which we have become familiar with, which is not overnight, but incrementally, where we are comfortable with the change. In fact, we want the change. Why do we want it? Because when I back out of my driveway and I haven't had my cup of coffee, I don't want to run over the neighbor's dog or cat that's sleeping next to that warm muffler. I don't want to run over that. And neither do you, or worse. And your car won't let you do that anymore. And you appreciate that. You want that. It's already in our son's car, who can't turn into the left lane in his late model car if there's something in his blind spot. The car won't let him turn into that lane. What's wrong with that? Nothing's wrong with it. And we like it. We buy that feature. We are the reason for the change. We are the reason for the change. We demand it. We are increasingly impatient with lines. When we came back from the reception last night, I guess there's a Baptist convention in town. And so there were long lines at the front desk. So back to my, how do I think about disruption? How do I think entrepreneurially? I'm thinking to myself, why are there lines there? Why are those people waiting to check in? Why? Why? Why, since almost everyone is pre-registered in some way, why doesn't their credit card, which they have to swipe, but you had to swipe anyway, for incidental charges, remember, when you checked in? Why doesn't your credit card open your door? Why? Now, we may all agree that that's a good thing. And by the way, it's happening. One of our clients is Marriott and they're testing this technology as we speak. So we will all have that within 3 or 4 years. But guess what? All of those jobs at the front desk. We as economic developers can lament the loss of those jobs because they will be gone. But we as individual consumers demand it. We demand it. Just as we do in our ability to get our boarding pass online, our ability to go to an ATM, all of these things that are job destroyers are there because we as consumers want them. That's why they're there. We are the reason for this change. No one's forcing us to use Uber. No one's forcing us to use, I remember in the era before credit cards. No one's forcing that when these companies offer it. We want it. And when we want it, it has these consequences. And we as economic developers won't connect the dots. We won't connect the dots. We could go on the list of things that are going to be disruptive, but we're going to stay with the automotive trends. And we're going to talk about some of these social norms. The safety feature. Now, I mentioned that there probably won't be any more accidents. What does that do to our police forces and emergency vehicles and so forth? Changes the way we make investments dramatically. Almost guaranteed. Almost guaranteed. And on the safety level, I don't know how many of you know this, but we lose close to 100 people a day in traffic accidents. We're close to the anniversary of 9/11. In any given month in the U.S., more people die from these traffic accidents than died in 9/11. We more or less accept it. We've had airbags and so forth. But airbags hasn't changed, obviously has changed this, but it's still an astonishingly high number. Imagine that if an airplane crashed every day, that's roughly what 737 takes, right? About 100 people, passengers. So imagine that happened every day. We would be appalled. And we should be appalled at this number, and it will change. And again, from an economic development perspective, all of those jobs that support this will change. Again, virtually guaranteed. Urban design. So the radicalness of self-driving vehicles extends to the bane of every urban area's existence, which is parking. So the self-driving car comes and gets you in the morning. It takes you to your job. You get out of it, and it goes and parks itself. And again, that's the kind of cool sort of nerdy talk about it, but the more important economic development discussion about it is that you don't have to own it. And if you don't own it, you don't care which vehicle comes to get you. And so the way we design parking for these autonomous vehicles undergoes a radical change. They can just be on a kind of a conveyor belt in a single high-rise, and the next car off the line is the one that comes gets you. And that's not hard to imagine. But urban design goes beyond that. It goes to our home. Think about, I looked this up in early part of last century, about 100 years ago. No architect designed a house with a garage. There were no garages because there were no cars. This is all happening in just a 100-year period. So in this changed ownership model, is it possible that this will ripple out into entirely new areas, such as architectural design? I think it will be. It already is. And again, I want to make it clear, I'm not a futurist. I don't know the future. I don't know what I'm talking about. I'm just looking at what's happening. And the rate of car ownership in New York City, is extraordinarily low. And so, and here we are, I'm from Austin, Texas, and we built our first large apartment building. It's apartment condo combined. I think could be wrong, I think it's 400 units. No parking. The city let the developer build an apartment condo complex with 0 parking. Does that boggle your mind like it does mine? How does that work? It can only work under one possible scenario, right? I mean, 400 people, probably 800, let's just assume it's 200. So we're aiding 800 people, and the developer is assuming that either they don't have a car or they'll figure something out. So this is happening again. This is happening. It's happening in real time. There's another radical change is in terms of mass transportation. So we got to look at the trolley. I thought the trolley, what do you call it? Streetcar. I thought it was pretty cool, but there was a question at the end of our tour. Someone said a question about laying new line. And the answer to it was, well, once we lay that line, we're committed. And he said it as if it were a good thing. But what if it's not? What if all of our investment in various forms of mass transit are up for grabs? Why in Austin are we going to vote on another light rail that will increase my property taxes by about $100 a year individually? That's a pretty astonishing number, because we need to match federal funds of about $1 billion, because it's going to be about a $2.3 billion light rail project. And so if this alternative future is there for us, and I am saying it is, what's the future of light rail? I don't know the answer to these questions. But I think we, as public policy people and economic development people, we need to ask them. We need to ask them. Because the expenditures that are being made for these various transportation systems, and let me be even a little bit more, let me step on some toes. For those of you who are involved in workforce who are training for demand jobs, what if that need to fill the gap in the private sector, and everyone says they want to help them do that? What if that's a fool's errand? What if we're thinking entirely in the short term, positioning people for jobs which will no longer exist? Do we have an obligation at a minimum to ask about that? I think we do. I think we do. So what does it mean for economic development? In a very practical sense, it means that we need to rethink the way in which we reward the companies we want to have come here. And it means that we need to break down the silos between workforce and education and have a more honest discussion about whether our entire training systems are doing anything more than filling a short-term gap, which would potentially be more damaging to the individuals we are training than doing nothing but improving their education. It's a question. It's a question. So I have a few more slides, but I want us to try to answer this question in a cooperative spirit. Because A, I could in fact be wrong. My joking about the pie chart of A, he doesn't know what he's talking about, and B, he's wrong, and 3, it won't affect me. The first 2 may be true, the third isn't. It will affect you. And I think we have that obligation to figure this out, because we've seen it already, and we've let our politicians get away with the discussion that is completely wrong-headed. We're not bringing manufacturing jobs back under either party's umbrella, because business doesn't want manufacturing jobs. Wall Street is rewarding the asset-light business, and they're doing it for that fundamental reason that business is not in business to create jobs. It's to serve the consumer, it's to satisfy shareholders, it's to remain competitive. So in that same context, let's look at one critical chart, and I've shown this many times, and I still find it hugely important to talk about, and that is indexing to 2000. We index GDP growth against job growth. Look at job growth gap to GDP. In any previous time in our history, those two moved roughly in parallel. They no longer, the gap is there and it's growing. And basically that gap is that a more productive company, industry, no longer needs employees to be productive. And that is independent of the sharing economy, which is a disruptive trend Totally separate from whether or not automation is changing industry, which it absolutely is. So even if I'm 100% wrong, and regulatory environment and everything else, and the internet goes down and there are no self-driving cars, it won't matter. This gap will continue. The correlation between a productive economy, you ready for this? The correlation between a productive, healthy, strong, vibrant economy and job growth no longer exists. That makes me a little bit sick to my stomach. I've been in economic development a while, and I always assumed that that correlation would hold, but it's not. And so, again, from the practical standpoint of what we do when we go to work in the morning, the way we design our incentive programs, the way we think about our training programs, the target industries that we're recruiting, the businesses that we want to retain, every single aspect of what we do in economic development, I am suggesting to you is up for grabs. And sadly, or not, I believe that. I'm not saying it just because there's a certain pleasure in scaring the cat and watching him jump up 2 feet. I'm a dog person, although we do have a cat. So, the question you will be asking is, innovation does destroy these millions of jobs, what will replace them? Now, there's a big debate, international debate, global debate, on whether or not we will be replacing those jobs. That we've gone through these transitions before, and jobs that were destroyed were created in new ways. I think that is a debate that we should have, not just in reading about it in the Wall Street Journal and the Times and Financial Times and so forth. I think we should have it with our boards of directors. I think we should have that in Joplin. I think we should have it in Kansas City. I think we should have it in Jefferson City. I think we should have it everywhere. Everywhere we need to have this discussion. We need to say that these disruptive trends, like them or not, are absolutely with us. They're demanded by the consumer. They're offered on a monthly basis, if you will, by new startup companies. The very companies that we want in our entrepreneurial activities that the folks at the state and in their communities, the growth of entrepreneurship and innovation, the creativity, you see it right there. Those businesses, every one of those people that you are trying to reward is trying to destroy jobs. Did you hear me right? Every young, and not necessarily young, every entrepreneur, every man, every woman that you want to reward for their entrepreneurial creativity has one indirect goal in mind, and that is to break the old job mold. Why? Because when we showed that initial slide about the disruptive trends, asset light, sharing economy, non-ownership model, that's what, and now I'm not talking out of school. No, I'm not. Because I have the privilege in Austin of being on some boards, and I get to hear entrepreneurial pitches about once a month or so, and every single company that I hear pitches along those three axes. Asset light, sharing economy, non-ownership model. So that whether they're creating apps or whether any of the other things that they're doing it because they know that the venture capital that you want them to have will reward them. And bear in mind that when they're rewarded that way, they're rewarded indirectly not for creating jobs, but for doing away with them. This is hard. This is standing in the eye of the hurricane that's happening around us. So what will replace them? And how should the economic development community respond? I'm not pessimistic about this. I do think we're going to create entirely different jobs. And we don't know what the future is going to look like. We absolutely don't. I have some slides in the past where where artists have depicted what the future was going to look like, and it doesn't look anything like what we thought it's going to look like. I don't know what the ownership model is going to be like. I've thought about it. I've had discussions about it. Maybe there'll be part of the reason that, why do we have cars? Why do we have them? Well, they're convenient, right? They get us places, but there's a vanity aspect to it too. So will there be people that own cars just for vanity purposes? Probably, you know. We'll pimp our ride in some way. I don't know what. But I absolutely don't know. But I do know that if I don't have to own a vehicle, if I'm actually looking at vehicle costs per mile, which people are doing, and I'm realizing that some kind of non-ownership model cuts my cost in half. By the way, the figures for that I can give you about what it means to cut the cost in half. But not only am I cutting the cost in half, I don't have to worry about having two different vehicles. My wife, who doesn't work outside the home, has a car at home for those occasions that she wants to run errands. And a lot of those errands are at Costco, right? And don't fit into my small car. So why do we need a big car if all she has to do is get on her app and call up a pickup or an SUV to go bring those things home? Why? Why do I have it? Why do I want it? So Mike forwarded an article from me this morning about the environmental effects of self-driving vehicles, predicting that it could be either considerably greater or much less than environmental impact than it currently has. Well, one of the interesting features about all of the self-driving vehicles is that they are increasingly independent of oil. Increasingly independent of oil. So, in other words, not only electrical, but potentially hydrogen. All of that becomes possible and is in the discussion phase. So I had some discussions with Tesla as well. And Tesla's interested. Remember, this is one slice of disruptive technology, this autonomous vehicle. Just one slice. And Elon Musk is basically saying, I'm really not in the car business at all. You know what business he's in, right? Battery business. He's in the battery business. So one of the other, and that includes, by the way, freeing residences from the grid. We could talk, there is no sector of our economy that is not going to be affected. We just use this one case study of autonomous vehicles. Every single one is going to be affected. Every single one. And on the supply chain side, back to Ford for a moment, what that same senior person at Ford said to me is the critical element in our supply chain, the critical element has nothing to do with the production of our vehicles. The critical element is software. That's the critical element of our supply chain. We're investing massively in software because we are facing competition not only from other traditional automotive manufacturers, but from Google and from Tesla. Alphabet really is the parent company that's handling this for Google. So that's what they're investing in. And that software is in communications, and it's also in whole new mapping softwares. So we use Google Maps, GPS. I never had a sense of direction. I love the fact that I have GPS, but whether or not Google remains the base for that, the mapping capability of these self-driving vehicles will be a critical element, and that's a software investment. So again, how should the economic development community respond? So I'm at the end now. So I am going to end on this note. I think that we need to answer the call. If you buy what I'm saying, if you buy that these disruptive trends are with us permanently, that they will affect every aspect of our economy, that the decisions your legislators make about whether or not Tesla can sell outside of the dealership network that exists, whether or not individual lanes of highway can be made available to autonomous vehicles, all of this regulatory environment, as one of your venture capitalists said to me from St. Louis recently, said to me, this battle will be fought in the state capitals of all the 50 states. In other words, he sees a regulatory battle going on. I want to say to you that if you fight that regulatory battle, you will lose economically. You will lose. I'll talk more about the Futures Council in a second, but I want to end on this note from my friend Chris Tomlinson. I said I wasn't going to be futurist, but I will be anyway. So do y'all know what this is? Some of you do. It's a drone. It's a drone. I don't know what to call it. It's not a taxi exactly. Let's call it a taxi. Now, what this thing does, it's, you've seen drones. Your kids may have them, fly them around. So this is a one-passenger, autonomous drone taxi. So you get on your phone right now, just the way I did when I landed at the airport in Kansas City and called up my Uber. I'll get on it. I'll call it up. It will come. It will land somewhere close to me. I will get in it, and it will take me to the Sheraton. So, John, are you really over the edge again? Well, no, I'm not. No, I'm not. Because this week, this is going into service in Nevada. It's a Chinese company that makes them. I wrote the name down. It's on my notes here. It's called EHang. It's been tested extensively in different parts of the world. Will this be the future? I have no idea. But it's not the future in the sense that this is working technology. So at the same time that you're still queasy over these self-driving cars and trucks, they may themselves have a limited future. All I can tell you about this is it works. I don't know whether it will be used. I don't know what other ramifications or implications it has. I just wanted to give you a teaser of the fact that while you're getting, and I'm no exception to this, while I'm getting my feet underneath me after this first blast of hurricane force winds, someone else is trying to disrupt that very thing that's disruptive. And you can see it. You can see it not over decades, but over years. Because when Travis from Uber said, we've created this ride-sharing app, he was already looking toward driverless cars. He was disrupting his own business model. Are you with me on this? He was disrupting his own business model even as he was creating it. Because the disruption was, you don't have to own the vehicles or you don't have to use taxis. Our cars can come and get you. At the same time that he's destroying the taxi industry, and we know that's already taking place. At the same time that he's doing that, he's also saying, what if I didn't even have contract drivers? So, to return to the last slide, what is the Futures Council and what am I talking about? It's my belief that the discussions that we have on a daily basis in economic development need to take these things into consideration. This can take place at the state level. It's already occurring at the metropolitan level. We have it in Austin. I've been a member of it. Seattle has it, and they are saying, what are the things that we need to be aware of when we invest money in mass transit, in urban development, in incentive policies, in the recruitment of companies? What are the things that we need to be looking at? And this needs to involve your businesses, your major employers at a high level, not at a junior level, at a high level, where they have the confidence that this discussion will be heard in the regulatory environment, in the design environment, and across the supply chain. So I think that we really have an opportunity, if we think more boldly, and we can talk more about this later, if we think more boldly about what it means not to resist these changes, and we don't even have to embrace them. We just have to know what it means to operate in a world where at a minimum, Wall Street is rewarding them, you, the consumer, demand them, and they're affecting our daily lives without exception. Thank you very much. It's always a pleasure to be here.